Well, we've officially made it through the halfway mark. We're over halfway through earnings, and so far I think it has been pretty good. Most big companies have held up their earnings pretty well so far, but we still have a ways to go. The job isn't done. We have a number of companies this week reporting earnings that are really meaningful. And we can look at the list here. Here are some of the most anticipated earnings of the week. I went ahead and circled the ones that I think are the most important. There are 9 different companies I'll be reviewing the earnings going into this week. Now, 2 of them, McDonald's and Palantir, this Monday, have already reported earnings. So we're going to be looking at what happened and see if that can better inform what's going to happen the remainder of this week. But Tuesday, tomorrow, we also have Spotify and Chipotle. Both of these companies have high expectations going into them, so we'll be looking at if investors are expecting too much. Then going into Wednesday morning, we have Uber. This is a company that was historically unprofitable, highly dilutive, and they're turning the corner. The CEO has dedicated the company to becoming real cash flow positive, so we'll see how they're doing along that journey. Of course, Wednesday after market close, we have the highly anticipated PayPal. Many retail investors invested in PayPal off the thesis that it was like Meta a year ago. It's a big company with a huge network effect that's at a very cheap valuation and widely disliked by the market. Can it have the Meta-like recovery? We're going to be looking at that with PayPal. Disney's a company that I like to keep track of. I believe Disney has lost the streaming war against Netflix. They didn't have a real battle to begin with, but Disney does have a recovery play. That's what investors are hoping for. A recovery in their overall cash flows, their media business, and what Disney plans on doing with assets like ESPN. There's lots of speculation that they want to sell it to companies like Netflix or Amazon. So we'll be talking about that as well. And then finally, getting into Thursday morning, we have Hershey's reporting earnings. We're going to be looking at how these consumer staple, very defensive companies are doing. And we also have one of my biggest holdings, in fact, my overall largest holding currently, which is S&P Global. This is one that I have very high hopes for. That one's reporting earnings Thursday morning. So this is a very busy week we're getting into. We've already had meaningful earnings reports and we have many more to go. Now let's go ahead and start this week off with Monday. Today we had McDonald's and Palantir report their earnings. Let's go ahead and start off with McDonald's. McDonald's is down around 4.5%, so a decent trade down. It was not a great reaction by investors. They had a mixed quarterly report. If we look at the details here, the headlines from CNBC, CNBC says McDonald's revenue misses estimates as Middle East conflict weighs on quarterly sales. Now, some cases I'll look at headlines like this and I'll think, is this an excuse? Are they just making up reasons that people don't want to pay more for their Big Macs? Maybe the customer is just sick of McDonald's. But in this case, I actually think that the headline is accurate. The Middle East conflict is weighing on their quarterly sales because of its association with the politics of it. So if we look at the reasoning they gave here, McDonald's has seen its Middle Eastern sales falter from boycotts after Israeli licensee offered discount to soldiers. So these franchise owners are getting into the middle of this conflict by giving special discounts to the Israeli soldiers. So that's a bit of a political move, and it's their right to support whoever they want, but that does come with a little bit of trouble for McDonald's corporate. Middle Eastern sales falter from boycotts after Israeli licensees offered discounts for soldiers. So this is having an impact on the Middle East, and it's having an impact outside of the Middle East. See, if a lot of people see McDonald's as being political or being in the midst, supporting one side of this, they may boycott the company, which is also their right. McDonald's CEO says that the company is seeing sales in markets outside of the Middle East weaken as a result of boycotts as well. He named Malaysia and Indonesia. Now, the issue here for McDonald's corporate is that they're not really being political here. McDonald's is not supporting one side or the other. This is the franchise owners in Israel supporting the Israel soldiers. And a lot of people don't distinguish between franchise owner and the corporation itself. So a lot of the Muslim majority population countries are looking at Israel and McDonald's support of the Israel soldiers and applying that overall to the entire umbrella of McDonald's. Because most people, the average person, is not going to make as big of a distinction between the franchisee and the corporate ownership. But this is a problem that McDonald's simply can't solve. There's nothing they can do about this. They can try to be apolitical, but as long as their franchisees are doing these deals, and as long as there's conflict in the Middle East, there's nothing they can do to escape this. Over time, I believe that most boycotts fizzle out, but there's always a chance that this continues to be a long continued drag on McDonald's sales. Other than that issue, I thought the report was fine. The reason that I don't own McDonald's currently is because it's growing a little too slowly and I think it's just a bit too mature for what I'm looking for. Now, of course, we have Palantir, which reported earnings today. The stock is moving a lot after hours. It's currently up around 15% after hours. On the day, it was down a bit, maybe 5 or 6%, so total today is up around 10%, which puts it in line with other stocks, a lot of other high growth companies this year, up around 10% this year. So if we look at Palantir, the takeaway that they have from this Barron's article is that the big thing that was a beat was the revenue. They beat revenue by around 5 million, which was up 20% over a year ago. Palantir does do a little dilution, but the dilution has been getting better as the revenue has been growing steadily. And as long as they keep that 20% top line revenue, investors are going to like this stock. High growth numbers there, 20% revenue every single year. That's the big takeaway from this earnings report. They say on an adjusted basis that Palantir earned 8 cents a share, in line with Wall Street consensus estimate. So they matched on an earnings per share basis. That came in line, which was great. But the bigger important part of this is the top line revenue growth. 20% revenue growth is difficult to get for a company as big as Palantir. So the fact they're able to maintain that is a very positive note. Now, Palantir is obviously trading at a very high valuation, but that's okay if the company continues at this level of growth. It warrants that premium valuation. The problem is, or at least the concern in the future, is if the growth slows down materially. If the growth slows down a lot really quickly, then Palantir is going to take a hit. But it does not look like that's happening today. Now, if we look at it right now, it's up 12, 13%. So we'll see if it sustains these gains after the earnings call, but so far so good. Now, moving on, we get into Tuesday. Before market open tomorrow, we have Spotify. Now, let's go ahead and take a look at how Spotify is evolving. The first thing is this new contract with Joe Rogan. He is by far the biggest figure on Spotify. He was exclusive to the Spotify platform, meaning if you wanted to watch a full episode of the Joe Rogan podcast, you would have to go onto Spotify, download the app, and watch it there. It was still for free, but you had to be on Spotify. They've changed the contract dramatically. First of all, the numbers released, and it's 250 million, which is astronomical. Spotify is paying a fortune to keep big figures like him on the platform. Under the new licensing agreement, Spotify will sell ads for and distribute the Joe Rogan Experience across several podcast platforms. So now it's not going to be exclusive to Spotify, including in a video format on YouTube, the company said Friday. So now it's going to be on YouTube, it's going to be on Apple Podcasts, you're going to be able to listen to it basically anywhere. And Spotify's probably hoping to gain more exposure and more advertising revenue from selling it everywhere. And it's conditional on meeting certain metrics to get up to the $250 million payment. But overall, I see this as a bit worse as having it as an exclusive on Spotify. Because Spotify had Joe Rogan where you had to be on their platform to watch him or to listen to him. And now you can get him anywhere. And I don't know if that's as powerful as a contract as they previously had. Another thing that I think is a challenge for Spotify is they're facing off with all of big tech. They're competing with Apple Music and they're competing with YouTube Premium, which includes YouTube Music Premium. That is an advantage that YouTube has over Spotify, even though YouTube Premium Music is arguably a little bit inferior. So these big tech companies like YouTube and Apple Music are competing fiercely with Spotify. And then on top of that, a big problem I have with Spotify's business model, one thing that I continually come back to, is the music labels have a royalty on all of the growth of Spotify. So as this company grows its top line revenue, like it's done historically at a very fast pace, that's great. But the issue is this also grows the revenue of Universal Music Group. It grows the profit of Universal Music Group. So Spotify's in this difficult spot where they're competing with every big tech company, and they also have Universal Music Group and other royalties eating away at their profits. That makes it more difficult for them to have this massive profit growth. Now, investors in this company, I believe, still have hope for significant upside. And that would be by them still flexing their pricing power and working their operating leverage. If they can negotiate good contracts with Universal Music Group, then they can grow their free cash flow faster than dilution. That's what they're trying to do currently. Here's the free cash flow over time. It doesn't look like a strong trend, but in the most recent quarter, we had $210 million, which was above the amount of dilution. So they had dilution go down a bit, they had free cash flow gain, which is a very positive sign. If you're an investor in Spotify, I want to see more quarters like this. Quarter after quarter of high free cash flow numbers and dilution being under control. Now, my guess is, despite these challenges, that Spotify will put up a good quarter. I think they're going to beat their estimates. Now, next up, after market close on Tuesday, we have Chipotle reporting earnings. And this is a company that I do have a sizable investment in. I have around $30,000 of value in this company. I just bought it last year during a dip, and it's in the green currently around 6,500. So if we look at where I entered into this position and where it is right now, if we look over the past year, I was buying in after this bad quarter. Chipotle had a quarter that was a little bit disappointing. With the high valuation, investors got spooked and sold off the stock a few $100s. It went from around 2,300 to around 1,800. I used that as an opportunity to accumulate a stake right there. And then Chipotle, all of a sudden, the next quarter, basically said that they're fixing all of these issues and they're projecting much stronger than expected same-store sales growth. The entire industry of fast food was slowing down a bit, but not Chipotle. They're expecting very strong same-store sales. So the stock raced back up, and now it's caught a lot of momentum with all these other stocks picking up. It's now at a price currently of $2,480. The valuation is very high, but for a reason. This company's growing organically much faster than most companies. You look at the revenue line, almost all of this is purely organic growth, meaning that they're just opening up new locations and pushing same-store sales. They're increasing the amount of traffic and they're increasing prices. They're increasing delivery through DoorDash and different means. All these different ways of making the company more optimized and increasing the revenue organically is incredibly good. It's exactly what I want to see with this company. So they've grown the revenue consistently at above 13%, very strong top line revenue growth. And then if we look at the recent cash flow of the company, this looks even stronger. From 2020, Chipotle has been a cash flow machine, generating ever-growing cash flows every single quarter, every single year. Now, it's not perfectly smooth like any company, but it's incredibly fast-paced. When I look at Chipotle overall, this year they're for sure going to end up with over $1 billion of free cash flow. I think next year, or in 2024 rather, they'll have above $1.6 billion. That's my estimate for it. Now, a piece of news came out recently that I thought was a bit surprising. This surprised me. Chipotle wants to hire 19,000 workers for the busy spring season, and they'll offer new financial perks to do so. So they're going on a big hiring spree. 19,000 sounds like a lot, and I wanted to see how much that was in proportion to the total employee base. When you look at that, the chain's recruitment goal is about 27% higher than a year ago. If they're saying that they want to hire 19,000 additional employees and they're putting out all of these incentives to gain more employees, I can't imagine them coming into this earnings season, this report, and giving bad guidance. I believe the guidance will be very strong. So I'm still very bullish on this company. I'm excited to see this next report. Now moving on, we get to Wednesday. Before market open, we have Uber reporting their earnings. This is a company that I've been very impressed with the developments that they've done over the past year. The CEO of Uber, about 2 years ago, he said that now is the time that we're focusing on generating real cash flow. The entire company is going to be focused towards that goal, no longer just growing at any cost, because he realized, he was one of the first ones aware that money's no longer dirt cheap. You can't indefinitely fund the company with infinite amounts of cheap money. That time is not rewarded anymore. So Uber had to grow now as a free cash flow positive company. They've been included in the S&P 500, which is one step towards maturity and becoming a free cash flow continually growing company. So I view that as a very positive sign. But we also just look at the financials. Over the past couple of quarters, I've seen a turn and change in Uber. Look at this. They went from a company that was very spotty. Investors were, I think, right to be a little wary of if this company is going to ever turn truly cash flow positive, but the CEO was correct. They made this a major focus and they've proven themselves for 3 quarters now. 500 million, 1.1 billion, 900 million. These are big numbers on a quarterly basis. So this stock is going to produce upwards of $4 to $5 billion in a single year in free cash flow. When I go into this week with Uber, what I'm looking for as a potential investor in this company is more signs of maturity. What are more signs of maturity from a stock? Well, first of all, continued revenue growth. I want to see top line revenue growth. I want to see the company continually produce free cash flow. I want to see their cost structure improve. I want to see them potentially doing buybacks. That's a big sign of maturity for a stock. If Uber actually used their free cash flow to start buying back shares, that's a really positive thing for the shareholder. So I want to see all of these things playing out more and more in this quarter. That's my focus this earnings report, the overall economic maturity of Uber continuing on into the future. If I had to guess, I think this earnings report will be really good. I think the company's going to beat their numbers. Now, next up, we have to talk about PayPal, maybe the most anticipated earnings of the week. PayPal's reporting their earnings after market close on Wednesday. This is a company where I see it as deciding between two things. Is PayPal a value trap, a company that's going to produce mediocre returns, grow slowly, and have its moat slowly picked away at competitors like Apple Pay? Or is it a company that's like Meta when people didn't believe in Meta, that's going to have a huge renewed growth, lots of economic value produced, and a huge growth in the stock price? Those are the different possibilities with PayPal, the different reasons people are investing in the company. One group thinks that the stock is really good and it's cheap. The other group thinks that the stock is likely a value trap and one to avoid. There's a couple things I pay attention to looking at PayPal's earnings. The first thing is the valuation going into the earnings. A lot of companies are going into this earnings season with very high valuations and high expectations. PayPal's not one of them. They do not have high expectations baked into the price. The forward PE is currently 11.25, which is super cheap. Most companies that have below a 12 or 13 forward PE are priced to be value destructive, meaning that this company is priced at a point where it's not really priced to produce value for the shareholder, meaning expectations are very low on an earnings basis. Now, looking at the free cash flow yield, the expectations are also very low. So the company is actually a very cheap company going into this earnings. That's a good thing for PayPal investors. The issue I see with earnings right now is that the free cash flow and the earnings per share have both been stagnant for a long period of time. The free cash flow has been around $1 to $1.5 billion per quarter for the past 4 or 5 years. So there hasn't been much growth here. We want to see explosive growth in free cash flow for PayPal. The other metric we can look at here, the earnings, you can see that they flattened out around 2020 and they've been a bit lower or the same ever since. Now, going into this earnings week, I believe that PayPal is more likely to have a positive beat than underperformance. And the reason being the simple valuation going into the earnings. PayPal's already priced at a very low multiple, so it would have to give very disappointing earnings to go lower. Now, after PayPal, we have Disney, which has its own set of issues. Let's go ahead and take a look at Disney stock over the past year. Year to date, it's up 7%, which is decent. If we look over the past 3 months, it's up 15%. Not great. If we look over the past year, it's down 11%. So this company has been continually disappointing to investors for the past 5 years, and then even going out 10 years, it's up 28%, excluding the dividends, which they never were a huge dividend payer. Over the past decade, Disney has been a disaster that's rewarded top executives like Bob Iger while giving almost no returns to the shareholders. They've gone into politics, picking political battles with people like Ron DeSantis. The company has done acquisitions that haven't created a lot of growth, and they have a struggling cable business, ESPN, that they're trying to now get rid of. We look at one person that stepped into this trying to solve it. Nelson Peltz is an activist investor that's getting involved in Disney. Nelson Peltz's plan to fix the streaming, to make it profitable, is to bundle ESPN Plus with Netflix. So the Netflix customer can sign up for a bundle with ESPN. I don't like this plan. And as a large Netflix shareholder, I do not want them bundled with companies or brands like ESPN. I view ESPN as a dying legacy cable brand, and Netflix is a new, fresh streaming brand. By putting them together, I think it diminishes Netflix's core value proposition and the brand. And I think that Netflix has a much better business model than ESPN Plus. So I would not support this plan as a Netflix shareholder, and I don't think that the Netflix executives are either. Now, overall, what investors are looking for in Disney going into this quarter is a resumption of free cash flow growth. They want to see it above $5 to $6 billion per year. And I think Disney will be able to do that. But the company has so many issues with their balance sheet, with dilution, with legacy assets. Those are a lot of troubles I don't want to deal with. I'd much rather just be invested in Netflix. Now, moving on to Thursday before market open, we have Hershey's. One misconception about Hershey's is it's just the Hershey's brand, but if you study this company, you'll know that they own a ton of brands. Here's some of them. One of their biggest ones is Reese's. That's their fastest growing. Then they've also purchased companies like Skinny Pop and Dots, which are sold in Costco's. So the company has a lot of market share everywhere. You'll see them control around 40% of the market share in the Walmart aisle for snacks. And there is some increased competition. I see a lot more different unique brands coming into play, but overall, it's a very stable defensive dividend paying company. When I look at Hershey's, I do look at it as a simple consumer staple. When I'm looking to purchase a simple consumer staple, I want to see free cash flow yields above 4%. So 4% free cash flow yield, we have that right now. That's a pretty good check mark there. Now we have a PE of 20, which is also not bad for a company that's this defensive. When we look at the 5-year performance, we can see that Hershey's got up to around $280, so it was traded up quite a bit in 2023, and it's since sold off big time. Investors have become a little bit more concerned about these consumer staple companies because of increased competition. So there is some chance that they'll have their market or moat eroded, but that's what investors are pricing in right now. I don't believe that that's going to be as big of a challenge for Hershey's. They have really good brands, they have really good distribution, they're all over the place, and they're heavily diversified. At the current valuation of a 4% free cash flow yield, a 19 PE ratio, going into this earnings with this quality of company, I think there's more upside than downside. And I'd be surprised if there's some kind of big sell-off after earnings. Now, finally, we get to my single largest position, which is S&P Global. They're reporting earnings Thursday before market open. This one for me, even though it's a huge position, I'm not too concerned about it. It's not one that I really stay concerned or focused or have a little bit of stress going into. I think it's going to be business as usual for S&P Global. Now let's go ahead and take a look at S&P Global's valuation going into this earnings, because this is a company that I believe looks more expensive at first glance than it actually is. If you're an investor that you just look at the forward PE ratio, and that's how you base your valuation, this company will look too expensive. It's trading at a 31 forward PE, which is at the high end of companies that I invest in. But if we look at the free cash flow yield, it's at 2.35% on a trailing 12-month yield. Now, they do almost no dilution, so there's very little stock-based comp, very little dilution. The cash flows that they earn are very efficiently returned to the investor. So we have a yield there of 2.35%. If we look at S&P Global's projections, their forecasts of how much free cash flow they'll earn in 2023, they project between $4.2 and $4.3 billion. So this next quarter should be a really big quarter. If they hit that, that means that the free cash flow yield on 2023 is 3%. So at a 3% yield, that doesn't look quite as bad, not quite as expensive, and going into 2024, I believe they're going to give very strong guidance for future free cash flow growth. I expect to see this line item continue on with its growth trajectory. Now, there's a chance that if interest rates do not cool off at all, if they don't go down at all this year, then the free cash flow won't grow quite as fast. But overall, I still think we're going to get above $5.5 to $6 billion in free cash flow in 2024, which makes this company not expensive. So with S&P Global, my biggest focus is if they earn that $4.3 billion in 2023 and their guidance for 2024. I want to see very strong guidance for the future. Now that's going to be it for this week. We have a very busy week ahead of us. And if you want to see more post-analysis of these earnings reports, make sure you subscribe to the channel. I'll have many more videos out this week. That's all for now. See you in the next one.